All right, everybody. GM. I'm Ellis, founder of Cracked Labs, and we are the executors of Som. Sorry, I'm now muting myself. I'm Ellis, I'm the founder of Cracked Labs. We're the host of Somnia Dreamathon, and today joining us is Adrian, who is the COO of Spartan Labs. Adrian, we've seen a lot of things come through the Dreamathon incubator in the last 8 weeks. We've seen some really cool use cases for not only Somnia, but also InfoFi just kind of in general. So through that, we've seen technical workshops, go-to-market, marketing assistance, community building, right? Bunch of cool things to kind of help these teams actually get off the ground. And you are our final workshop, right? So today we're going to be talking all about actually getting in front of the money, right? And what you can do to actually capture attention and not miss an opportunity if it's in front of you. So everybody, if you are in the audience and you're watching, if you have questions, do drop anything you can think of into the chat. We'll go through Q&A afterwards. After that, I'm going to ask questions to Adrian directly. And again, we are super excited to introduce Adrian from Spartan Labs and Superfund. Adrian, say hi.
Sweet. Hey, everyone. Thanks so much for the intro. It's been great following the progress of the Dreamathon, and I know you guys are at the final stretch. Great job, and let's take it home. So, just to introduce myself a little bit, I'm the Chief Creative Officer of Spartan Labs. We are the AI research lab and product arm of Spartan Group, which has a VC and advisory arm attached to it as well. We've been doing a lot of research as of late around, funding distribution mechanisms using AI. We are running the current dashboard for Dreamathon, and would love to just share with you some tips as you get into this final stretch on VC readiness. So today we're going to cover 10 things you need to know on that topic. And the first, chances are if you're planning to fundraise, if you're here, you're probably planning to fundraise off your Dreamathon demo or within this next 6 to 12 months. I really like this quote from Paul Graham because it kind of speaks to the dynamics of fundraising. Fundraising is brutal. One of the most horrible things about fundraising is how distracting it is. So in this workshop, I'll cover 10 things you need to know about about VC readiness. And I guess I also want to zoom out a little bit because ultimately VC funding is just a means to an end. Understanding that dynamic will really help set you up for success because it turns out that's what VCs really care about when evaluating startups. So ultimately, what is the end goal? I would say that is minimum viable runway, which is the minimum recurring revenue needed to cover survival costs to validate the business. So VC funding or fundraising is ultimately just a means to an end. 90% of bootstrap startups fail, not because they build the wrong product, but because they run out of runway before they figure out what the right product is. So runway really depends how long you can survive before you figure out what the right thing is. Why does this matter for VC readiness? Because VC funding is just a means to extend that. And VCs today really focus a lot on traction. So you can't raise to figure out your model. How do we establish how to look at where we are in our startup stage? I'd like to present this framework that is a 7-point fundability checklist. So the 7 points on here are you uniquely positioned to build this? Can you demo something that is working? Do you have users or partner interests? Can you clearly explain your business model? Have you validated demand for that business model? Can you ship weekly and iterate fast? Do you know 3 investors for your stage and thesis? And can you survive 6 months without funding? So take a moment now and score yourself mentally and then count your check marks. Because that maps to the readiness spectrum. If you scored less than 4 points, then you should probably build first. So your focus should be on building that minimum viable runway and product market fit, finding traction. The path for that could be grants, but really focusing on acquiring those customers. And the timeline is probably about 6 months. If you're 4 to 5 points, then you can start some warm conversations, strategic conversations, focus on relationship building. And if you're 6 points, then you're ready to go. Focus on full campaign mode, and you're ready to execute a fundraising campaign. And as we go through the tips in this workshop, this will be your tactical playbook for execution. If you're 6 to 7 points ready, then you want to execute with confidence and urgency. But the key point is that understanding where you are helps you optimize your time, because building those relationships too early can waste them, and waiting too long can also cost you momentum. So today we're going to give you some clear execution paths based on where you are. Let's get into this. So how to build runway without raising. I guess we established what minimum viable runway is. Let's talk about how to actually build it. Here's the common approach most founders take. I need to build the perfect product first, and then I can get revenue. That's one way to do it, but there's a faster path to runway, and the framework is demo, sell, build. So let's break this down. Demo is creating a compelling offer without building the full product. So that could be mock-ups, prototypes, extremely articulate value, clear value proposition, and a strong offer with clear value and risk mitigation. Step 2 is sell that. So get commitments from early customers, pilot programs, pre-sales, letters of intent. This validates that people actually pay and validates that there is latent demand for your business model, not just that people are only interested. And then step 3, then you build it. So you can use the committed revenue to fund exactly what was validated, and you can build what customers pay for. So test with motivated paying customers who have skin in the game. The rule of thumb for minimum viable runway is usually 10K monthly recurring revenue per founder. So that could be your target, but adjust it based on your own business model. But that's generally the ballpark that lets you, gives you enough confidence and commitment to continue. The second rule is to really understand why you're raising, or if you should be raising. So the question to ask yourself is, what is the specific reason you're pursuing VC funding? The reality is that strong reasons fall into 4 categories. Number 1, you might want to accelerate proven traction, right? So you found product market fit, now you want to scale fast. Number 2 is extending runway to hit a milestone. So you're close to a key milestone, but you might need bridge capital to get there. And then number 3 is hiring for an expertise gap. So maybe a major partner needs capital or scale as a prerequisite to work with you. And then there's also weaker reasons. So figuring out your business model, because that's what you should be doing, because that's what startups do, or you might need money eventually. If those are your reasons, then you might want to wait to fundraise until you have stronger leverage, because your strongest position is when you have options. Investors see opportunity, not desperation, and your weakest position is always when you're running out of cash. That's why minimum viable runway matters. Runway gives you negotiating power. So think about the key point, which is have a clear reasoning about why you're raising, which helps you evaluate whether now is the right time or not. The third tip is that your business model is actually more important than your product. So this is a mistake that I see all the time. Founders spend time perfecting their product before understanding the business model. The reality is that VCs fund business models that work, not just products that work. And when you're thinking about your business model, you want to think about what problem are you solving, who's paying, how much, what's your unfair advantage, the dynamics of your business. Can this work repeatedly and at scale? There's a difference between the product, and which is what you build, and the business model, which is how you create and capture value. So you can have a great product with a broken business model. You can also have a mediocre product with an excellent business model. And but oftentimes VCs really look at the business model over the product, because they're not just funding your product idea or features, they're funding proof that your business model works at scale. So what they want to see is things like repeatable customer acquisition, clear unit economics, sustainable growth, defensibility. For crypto founders specifically, there are, I guess, two types of business model types when it comes to tokens. Understanding which one is critical to your fundraising strategy. So the first is token as speculation. If this is your business model, then you want to build traction first, because in this model, the product can work without a token, and the token is primarily for ownership, governance, or network effects. So a good example of this is Hyperliquid. They built the product first, they had product market fit, and then they launched the token. The framework here is PMF first and then token. Make the early users rich, not insiders. And the second type is tokenist mechanism. So with this, the token is the product. And with this model, you want to ship fast and iterate. So in this model, the token enables coordination or incentives that can't exist otherwise. A good example is a project called TokenWorks. So if you haven't heard about it, you can look into how that token works. It's a very simple model, but you can kind of understand that that would not exist without its token. But for this, the test is really know which business model that your type that you are, and then execute accordingly. Both can work. They just require different approaches. The fourth point is focus your investor targets. So the common mistake is a spray and pray approach to anyone with either crypto or VC in their bio. The reality is that targeted research converts 10 times better than mass outreach. So the framework is do your homework. First, look at the different dimensions of alignment: stage alignment, thesis alignment, portfolio alignment, geography, less important, but look at that as well. Check sizes. Are they crypto native capital? Are they actively deploying? So don't pitch the wrong stage. It wastes everyone's time. Read a lot of VCs these days have media and content arms. So read their blog posts, their tweets, their podcast appearances. You can get a lot of alpha from the content that they put out. Understand what sectors they look for. Look at their existing investments. Look for adjacent companies in your space, and understand if they lead rounds or follow. Also check out if they've invested in competitors. That could be good, that could be bad, but you need to know. And in terms of crypto native capital, look for strategic investors who have deep understanding of token economics and mechanics. Can they actively participate in your network? Through nodes, staking, governance, are they long-term aligned, or are they just trading positions? But the key is to immerse yourselves. For example, like Alliance literally publishes a guide on how to get in. Read the content, understand the investment criteria, join the communities. So a good tool for this that I would recommend is this one by Decentralized, which is also an amazing newsletter. But they have this tool where you can see the latest venture rounds, you can search through investors, you can see what they've invested in, and you can kind of use this to get a sense of what their stage or categories that different investors invest in. The next tip is how VCs evaluate execution speed. So the question that, if you don't have traction yet, then the question that most VCs are going to ask and what they will focus on is, can this team execute at speed? So teams that ship weekly will stand out from teams that ship quarterly. And the framework here is pretty simple. Can you ship meaningful updates every week? Are you iterating based on feedback in real time? Can you demonstrate this? This is one reason why we have the Dreamathon dashboard, because ultimately, as you're shipping, and you're shipping well, you should be able to use this to just share it with an investor, and they can look at this and see that you're making progress. There's also a something called the formidable test, which is kind of evaluating yourself. So if you were an investor, would you invest in yourself? Can you take an idea and turn it into reality? Do you have the execution speed needed to find product market fit? Are you learning and adapting quickly? If you don't have traction yet, execution velocity is what one dimension that investors can bet on. Okay, the next thing that investors can bet on is founder market fit, which if you're very early, sometimes this is what you have going for you. So here, this is deeper. This is about something that you can sustain for the long term. So let's break this into 3 parts. The first part is personal connection to the problem. The question VCs often ask is, why are you uniquely positioned to solve this? What they are looking for is personal experience with this problem over time, deep understanding from direct exposure to the category, an authentic need to solve this problem, not just finding an opportunity. And so a strong positioning would look like something like, I've worked in this industry for X years, I've seen this problem repeatedly, and I tried to solve this at my last company, or I've experienced this pain point personally. Weaker positioning would sound like, I identified a market opportunity, or this seems like a massive sector, or I think this could be highly profitable. The second part of this is a track record of persistence. So have you demonstrated ability to stick with hard things? Why this matters is because successful startups are multi-year journeys that constantly face multiple near-death moments. So that could include running out of capital, competitive threats, team changes, the market shifts. Founders who have navigated difficult situations prove that they have the resilience needed. And what counts as evidence here is a previous project that you sustain over multiple years, significant obstacles that you've overcome, time invested in this specific problem, which you can demonstrate through having a track record in this category or previous attempts to solve related problems, or a long-term commitment here. And then part 3 is learning and evolution. So the question is, could you grow into the CEO role that this company needs if you're very early on in the journey? And here, what we're looking at is curiosity and willingness to learn, self-awareness, a track record of growth, and the ability to adapt. So you don't have to, if you don't have traction yet, executional velocity, and then founder market fit. So you need to demonstrate the ability to achieve it over time. And both of these are what investors can bet on in the early days. Okay, so the next tip is treat fundraising like a campaign. And what that means is, in reality, is how do you structure your fundraising process? The reality is effective fundraising runs like a coordinated campaign, not sequential conversations. So it might look something like this. Week 1 to 2, you prep your materials, launch outreach. Week 3 to 6, you meet 30 to 50 investors in parallel. Stack the meetings and calls. Week 7 to 8, you create competitive dynamics between the investors, and you move it to a close. Parallel conversations creates natural urgency, and it also generates competitive interest. And thirdly, you learn from each conversation, so you improve with each one. And then finally, it allows you to enable better terms through optionality. So have 30 to 50 conversations that create momentum instead of sequential conversations that lack urgency. You also need a full pipeline working at the same time, and always have your materials ready. Warm conversations or warm intros typically convert 10 times better than cold outreach. So even if you're not ready yet, start building those relationships now. Send out the monthly updates and be top of mind before you need capital. In terms of materials that are must-haves, have your one-pager or blurb ready. Have it in a format that is easily shareable across Telegram. Oftentimes, the way it finally gets to the analysts who are making decisions is through multiple shares. So make sure it's very easy to copy and paste and doesn't break when it's shared from Telegram into Slack into multiple channels. Also have your deck ready, a light deck, which you can iterate over time, demo or video walkthrough, and then a basic financial model. So the great thing about the Dreamathon profile pages is that all of this is also there, and you can even use this as a light data room. Yeah, there are nice to haves and things you should skip are a detailed data room if you're having the first initial conversations, as well as a deck that's too long and a super detailed white paper. Tip number 8 is how to manage your fundraising pipeline. So now that you have these parallel conversations going, what do you do next? And you need a system to track and advance them. You can use a simple spreadsheet or a CRM, but what you want to track are the investor name, their fund, the current stage of your conversation, whether that's a meeting, a follow-up, or term sheet, last contact date, next action item, and then keynotes. And the process should look something like you managing 20 to 40 active investor conversations, reviewing your pipeline on a weekly basis and updating that, and then tracking momentum and identifying where things stall, and using those competitive dynamics strategically. Never leave a meeting without knowing without some clarity on what the outcome could be, but the best outcome is always a commitment or a term sheet. A good outcome is clear next steps. So you have a follow-up meeting, reference calls, specific information requests in terms of due diligence. And then acceptable outcome is a clear no with reasoning. But a problematic or ambiguous outcome is we'll think about it, because then you're constantly chasing for an answer without knowing, and it can end up wasting your time and killing your momentum. So always push for clarity. Ask, what are the next steps? What's the timeline? The key point here is that pipeline management creates urgency. So yeah, you want to close the round as fast as possible. The tip number 9 is, what is the real cost of raising money? So the reality is that equity is actually the most expensive way to extend runway, and understanding the economics of that helps you make better decisions. So just an example on the math. In scenario A, you're raising 500K at a 5 million post-money valuation. That's 10% dilution. If you exit later at 20 million, that 10% that you sold costs you 2 million exit value. In scenario B, instead of raising, you cut 40K out of your monthly burn, which extends your runway by 12 months. So 0% dilution, but the same runway. If VC funding is a form of funding, and if funding is a means to an end, then these are 2 ways you can get to the same outcome. You have 3 ways to extend runway. The first is revenue growth. The second is expense optimization. And the third is fundraising. So if you've decided to raise, you should be asking yourself, how many months does the capital buy? Can you achieve similar runway extensions through revenue or cost management? Can you reach profitability in this round? Or what milestones is this round going to enable? Early stage equity is extremely expensive, so having more leverage before raising equals better terms for you. Consider all your options before raising. And the final tip is alternatives to VC funding. The reality is VC is not the only path. Depending on where you scored on the checklist, there might be some alternate paths that might be more strategic. Some of these include grants. So usually these are 10K to 200K. This is non-dilutive capital. Usually based around some form of milestone driven mechanic. And then this is best for validation stage. Accelerators like the one like Dreamathon, usually you have to give up some form of equity, but with Dreamathon not. So that's great, but these are great for early traction. And usually these are, the benefits of these is structured program, network access, and potential follow-on funding. And then third is token sales. So the strategic value here is, I guess with token sales, there are newer ICO 2.0 platforms such as Legion and Echo, and there is token dilution in terms of selling some allocation out of the fixed supply, but not equity. But this is really best for a proven product. So these 3 can help you build minimum viable runway while proving traction. And then you can approach VCs from a position of strength. So we do have a product called Superfund where you can use to discover funding programs, grants, and perks. You can upload your project and you can match with different programs and see what's available. This is regularly updated, so it's also a good source to find alternate forms of funding. So in summary, review your 7-point checklist score. If you scored less than 4, then you should probably focus more on grants and on building up your minimum viable runway. If you scored 4 to 5, then you should start soft conversations with VCs, warm intros, keeping that going, sending your monthly updates. You can send monthly updates even to potential investors, not necessarily your actual committed investors. But if you scored 6 to 7, then you can begin preparing your materials immediately and start structuring your campaign. Figure out where you are in the fundability checklist and then match your actions to your current position. Because patience often leads to better outcomes than rushing the process. So to summarize, capital creates expectations and timelines, and your focus should be on shipping and finding fit. The companies that will succeed prioritize building over fundraising. The most important thing is get the capital you need and then get back to building. The goal is to build a great company, and fundraising is really fuel for that journey. So yeah, I guess that concludes the workshop presentation, and would love to open it up for Q&A and answer some questions.
Awesome. Adrian, your presentations are always badass. I will say that. And I will venture to bet that most of the people in this audience understand just what it's like to be under the gun with lack of revenue, trying to prove product market fit, simultaneously take the time to go out and raise rather than beat the street, right? Let's go through and see any questions. I really haven't seen anything as of yet, but actually here, could you please share your experience in closing a lead with cold outreach? I could probably take that one if you don't want to.
Yeah, why don't you start and then I can chime in.
Yeah, I'll say this. So it depends on the vertical that you're in. Things have changed a lot in terms of, the last 10 years in terms of how people pick up the phone and consume information and everything else. If you're in crypto, it's pretty straightforward. You really only have one option, maybe two, technically three, but Telegram, LinkedIn, Twitter, in that particular order is what I would kind of say. Keep it brief. If you can't tweet it, delete it. If you can get a warm referral into somebody that you strategically want to talk to, even better. But keep it short. Don't drone. Don't send out a novel. Best advice I can give you. Adrian, what would you add?
I mean, I think that was a point in one of my slides, is that don't even do the cold outreach. You're just going to waste your time. Try to get a warm intro. Try to go to, if there are conferences, go to side events. Try to get someone who knows someone, and then make your blurb as shareable as possible, so that person can share it to the next person, who can share it to the next person, and can get to the person who actually needs to see it and digest it very quickly, because they're looking at hundreds of these, and just make it extremely easy for it to be passed on. That initial, like, if it is a cold outreach, then the format is like a pass on game or telephone, but ultimately try to get a warm intro to someone who works at the company, and then just build a relationship with them over time, even if you're not ready to raise yet.
I would, particularly in terms of VC, you probably shouldn't go direct on a cold outreach when it comes to actually pitching your product, right? If you can make an association through offering something else, do that first, and then the person, then you can reach out directly, right? There's some strategic stuff there. Let's see what this one is. Share your experience about creating FOMO and exclusivity. That's a good point. It brings up something that I actually wanted to talk about that you had mentioned. So there's a very big difference in terms of confidence and tone and even opportunity when you have those 7 success metrics to point to, like you said, right? prior to those 7, if you yourself don't know what the actual upside is for the investment opportunity that you're presenting, then you're probably not going to get a check. And I think that a lot of times startups, businesses, crypto in particular, are selling kind of the dream, right? But they forget to sell the investment opportunity as an investment opportunity, right? So how can you influence that momentum so that you can come into the call knowing that you've got shit that people want, right? Because if there's no investment opportunity that you can see, why in God's name would anybody invest in it? Right? So like how can you create that FOMO, that momentum, that inertia to actually get somebody to write a check?
And to add to that, I think that is probably could be a separate like book on its own,
Yeah.
titled The Dark Arts of Fundraising. And yeah, there are a lot of different tactics, when it comes to raising. I mean, some of that, yeah, exactly. Some of that could be who else is thing, or who is the lead, who's committed, and I think that's why it's so important to close a lead, and especially if you close a tier 1 lead, because everyone FOMOs in from there. But if you have very strong traction and attention, investors will come to you, and if you have a very strong lead, other investors will follow. So sometimes you might start with like an angel round, yeah. But yeah, I mean, ultimately, like zooming up high level, the best position you can be in is if you are the magnet that is drawing the leads in, and then people come in from that.
The friends and family round is called a friends and family round because it should be a good opportunity to make money early, not because you need your friends and family to keep your lights on for 6 months, right? And yeah, I think that a luxury, it probably does feel like a luxury to be able to actually choose your lead that would be like a strategically aligned lead when it comes to rollout and network and all of the other things that are more than just money that should be kind of part of the equation too. Which let's talk about that for a second. When it comes to actually picking an investor, let's run through 2 scenarios, right? Let's say you've got the hot new thing on the block and you can actually, have your pick. Who should you pick? And then I would say the second part of that would be, let's flip the table and say you're now 8 weeks in and you've been shopping this around in limited kind of response. So like, what do you do then? But let's go back to the first one. So Adrian, how would you, if you have the hot new product, how would you know what lead to pick or who to shop around to?
Yeah. So that goes back to like doing your research on investors, not just going for any investor, but yeah, using the decentralized tool. There are other tools, seeing who matches basically who aligns with your thesis, and who can provide not just capital support, but also network support, and also knowledge capital as well. So that's one way to do that, and there's multiple dimensions you can assess if an investor is the right strategic fit by looking at their portfolio. Can they help with your BD pipeline? Can they help with your network, and do you get along with them as well? Getting investors, finding investors is sometimes like finding a co-founder. So you have to treat it as a marriage as well. And then the second question is, what was the second question?
Yeah. So let's flip it and let's pretend that you are a scrappy, gritty startup. You've been around for a while. You've had some traction. You've plateaued, and you've pitched a bunch of VC, but there really hasn't been any response. So you're kind of in that like grant purgatory land.
Right.
Then what?
Yeah. Well, I think finding investors also like almost like finding your market, right, for funding. So same with product market fit. It's finding your market for your business model, finding investors, finding your market for funding. And if you can't find that market, then there's probably something wrong. And the best way to figure out what's wrong is to get actual feedback from the investor. That's why it sucks when you don't hear back and you don't know what to do and you're kind of in purgatory. But ultimately, you want to push for that feedback. And if not, then you kind of have to pick up on the signals and look at what you're doing wrong, which could be your approach. You don't have enough traction. The market's not there, or it could be something like they're not actively deploying, or maybe they're just not the right investor. So I think as a founder, you kind of have to be very sensitive to those signals when the market is not receptive, and figure out what is the bottleneck or what is the thing that's getting stuck, and really analyze that with like a fine-tooth comb.
I'm muted. You can't fake PMF. Unfortunately, it's one of those things. Looks like we've got some more questions. So it's one question everybody asks is who else is raising or who else is investing, I would expect, when no one's given a commitment. How do you solve for that? So chicken or the egg?
Yeah, I mean, I think that kind of overlaps with the last question as well. If no one's given a commitment, then if you can't find a lead, then you can, find the alternate funding paths, or raise a smaller round, or raise friends and family. But ultimately, you are raising to extend runway. So you should also look at different ways to extend your runway, right? And ultimately that will lead to traction, which will then help you, have a more successful fundraising round. But I mean, the best way to raise is if you have traction and you can run it like a campaign, instead of an ongoing permanent fundraise, and then get back to building and shipping.
What do you think, like from like a bands or a range kind of scenario, given the current market conditions, is there any advice that you can give to the founders that are watching in terms of what they should be actually trying to, raise around? Is it a good time to be conservative, or is it a good time to go aggressive? How would you weigh that, given that, like, let's say you do have a good PMF, you've got a high, potential FTV. Do you raise on the aggressive side, or do you raise on the conservative side right now?
I think early stage is a little more difficult right now in terms of the fundraising landscape. The capital being deployed is a lot higher than last year, but they're more consolidated into later stage companies. And I think in general, people are looking more at fundamentals and traction and revenue, more so than in previous cycles. So with early stage, PMF traction is key. Not just social clout or like having strong fundamentals is key. And sometimes it takes time to build that. So you can't really, if you're not getting strong signal from investors, then that might mean that you just need to spend a little bit more time building up that traction, and waiting for that right moment. Yeah.
The founder curse of being early most of the time, if you're building in crypto, right? A very specific question, actually, from Melvin. If you already have a DEX token with low market cap, should you remove it from your company before going to raise, since TG is an exit event for all VCs that they're looking for? Would you, and I would say, would you agree that primarily VCs in crypto would be looking for a token play? And if you have already done a token and the toothpaste's kind of out, should you burn it and restart, or how should you approach that?
I think VC, like crypto VCs, will be looking more for token allocations than equity. Definitely. If you already have a token, it's quite difficult, because then you have to look at what is the role of that token in our ecosystem, and our essentially ownership structure, decentralized ownership of the protocol. So if it is tied to governance of your project, then it might be a little bit more complex than if it was just a token that you launch that didn't have any linkage or utility back to the product or the protocol. But there are different ways to navigate that. One might be through a partnership with another protocol, like a merger of tokens, or a rebranding of the project, or even launching a second token and having sort of like value accrue to the secondary token owners. But I guess there's no easy answer. It is quite a complex scenario to model out, and it kind of depends on how you have it, the role of the token, and how it was set up in the beginning. But it's probably something that you need to something that it'll be harder than like if you didn't have a token already.
Let's shift gears a little bit and talk about some of the things that we're building at Superfund. So we see, obviously, the VC landscape is not only fragmented, but somewhat broken, I would say, in terms of the amount of allocation, how funding's allocated, the fact that things slip through the cracks, right? What is Superfund and Somnia? And guys, stay tuned for more on this coming soon. But how are we solving for some of these things that are evident in the market, that like you can see out there with Echo and with Legion and with Nozomi, right? So like, let's talk a little bit about some of the things that we see and some of the ways that Superfund can help.
Yeah. So I think one of the things that we're really interested in is in like internet capital markets, and how formation of capital through crypto, and how that can how early stage projects and founders can leverage that. I think what we're seeing a lot in the space is focus more on fundamentals, so that kind of like extends itself into milestone-based funding or merit-based funding, or really tracking that, being able to track projects in a closer way, and in narrower sphere or narrower cadence, versus grants, episodic grants, or big funding moments. Especially now that it's easier than ever to build an MVP. That's why I think the concept of MVR, minimum viable runway, is interesting, because it's so easy to build these days that anyone can build. But if you can break out that kind of funding event into more discretionary tranches based on merit and milestones, I think that's that area, that category, and that problem space is something we are super interested in. I think Superfund we're actually working on a V2 of Superfund that's going to be probably called something else, but I think Dreamathon is really a really strong pilot to show how projects can really, or how projects can be tracked through like on-chain data and metrics, and then ultimately how that can be rolled into more of a continuous funding cycles versus the traditional grant and VC structure. So I guess without revealing too much, that's kind of what we have in our minds and what we're researching and exploring. So yeah, hope that answers your question.
More to come in a few weeks. Stay tuned. Subscribe if you haven't already. Click the follow button on Dreamathon, Cracked Labs, Spartan Labs, and Superfund XYZ. And you'll certainly be in for some surprises. We think we've got some awesome stuff planned. It's going to really move the needle. So looks like there's another question in the chat. When we're building a community-driven product, what's your advice on where it should invest the VC funds on the product more? So what about usage of funds and allocation of capital? How much time should be spent product versus marketing and BD and all of the other stuff?
Yeah, I mean, I guess I also covered this a little bit in the presentation, that business model is more important than product. So looking at your product is really like looking at your features, but looking at your business model is understanding what are the dynamics of capturing value, which could be revenue, and what are your costs. And if you have a strong understanding of that, then then you have the ability to sustain a runway, and ultimately that equates to traction, which attracts the VCs. So with a community-driven product, I think probably the business model is around community, and you have to figure out, I guess you also have to figure out how do you monetize those users, because free users that aren't monetizable is also very wasteful, and costs money. So probably looking at like what is the business model around that community will help inform what is going to be attractive to the VCs and the funds versus the product.
At the end of the day, people invest in opportunities to make money.
Yes.
Right? Period. So unless it's a public good, in which case you should be asking for a grant and not an investment.
Yes, exactly.
Right. So let's say that you are a project. Let's say you have a very scalable revenue model, but it's not necessarily based on tokenomics. Do you raise? Do you go community? Do you go to Web 2 instead, right? If the token is there, but it's not necessarily the liquidity event that the VC might want, would that turn off VCs in this market, or like how would you play that?
Well, I think you don't necessarily have to have your token. Well, you can have an idea, or you can have a plan to launch a token eventually, but you might not need it fully fleshed out when you're raising from crypto native VCs. because you can raise future token allocations, SAFs, and you can raise different instruments where the token can come later. So I don't think you necessarily, if you're a crypto native startup, you don't necessarily need to have like everything fleshed out yet with your token, because you can almost defer it to later, as long as that that's part of your plan, and there are instruments that allow you to do that.
There was a scene in Silicon Valley, which you might remember, where he's like, "You're pre-revenue. Don't focus on revenue. If you're pre-revenue, people can only think about how big you can be. As soon as you start tying down revenue numbers, then you're like actually in a box, right?" Which is ironically very true. That continues to blow me away. But anyways, all right, guys, for those of you listening, any questions for Adrian about VC readiness, what to do on the road to kind of VC readiness? As of right now, for those of you that are part of Dreamathon, you will have already launched your testnet contracts, your mainnet contracts. We've given a little bit of extra time for additional polish that you need it so that you can do user acquisition. We will drop the dashboard link here. So as a reminder, and maybe we should talk for a second about the dashboard that we're running for the 15 projects that are in, whoops.
Nice, you have the dark art stack ready.
We agree on titles. So yeah, maybe you should pull up the Dreamathon dashboard. We can walk people through kind of what that's all about. And for those of you that are listening that are not part of the Dreamathon cohort, hop on the dashboard, check out the projects. You can see the live demo links and upvote or downvote the ones that you like or don't like, right? It's all about community involvement. Do you want to pull it up, Adrian, or do you want me to?
I'm happy to. I have it open already.
Sweet.
Yeah. So should I run through this or?
Yeah, please.
Cool. So this is the Dreamathon V2 dashboard, where you can go and see all the teams that are participating in the program. Every team has its own public profile, and the teams can upload their own information about the team, as well as media around the team. We have plugged in data sources that are both on-chain and off-chain. So we have the original application score when the team applied, as well as some metrics aggregators around development activity, on-chain activity, and community. Part of that will be the upvotes on these projects, as well as the traffic to these pages and comments. But that's not the only metric that matters. So we do have multiple data feeds that are being displayed for each team. And this is just a way for people to see the progress that these teams are making. And then also, speculate on which team is going to come in on top of the leaderboard. We are looking at closer sources of integration with the Somnia chain, including integrating data streams. So that's going to be super interesting. And then currently we have also a prediction market feature where we have AI agents basically betting on like which projects are, or whether projects are hitting their milestones, as sort of an experimental fun feature. But yeah, that's it. I mean, I think this is kind of like V1 of this dashboard, and hopefully soon we can expand on this and turn this into something that is going to be a bigger program.
Yeah,
do you have anything to add, Ellis?
Yeah, so remember, guys, that Dreamathon was the pilot incubator for the Somnia network. So this was very much a great proof of concept that will continue to grow and continue to kind of be iterated on. And like Adrian mentioned, we have some really, really sweet surprises that we're going to be able to announce here very shortly. that we think solves a lot of the problems on two sides, right? Because I think everybody building needs to also remember there are problems on the grant side and there are problems on the startup side. The startup side, right, it's hard to get funded. You got to have the PMF. You got to jump through the hoops, and there's a chance to die. On the grant side, there's a lot of money, but you're still on the hook for it. And ultimately, it's far too common for someone to get a big fat check, misallocate funds, and just, disintegrate at the end of the day. So with that, we'll be bringing some unique features to market that are going to bring some serious hype and serious momentum. So look at the chats. So there, we have the link to the Dreamathon dashboard in the chats here, guys, for all of you that are listening. And yeah, I mean, we're coming up on time, Adrian. As always, thank you very much for your knowledge. It is very helpful, to say the least. And like I said earlier, if you haven't yet, give us a follow on X, hit the subscribe button on YouTube. There's going to be a lot more content, a lot more things coming up. For those of you that are part of Dreamathon, again, the deadline for project submissions is November 30th, 11:59 p.m. Eastern time. So get everything submitted to make sure you're good to go. And then we will be announcing winners probably within a week or two after the project submissions are due. There will be a demo day between a bunch of early stage VCs for the top 5 projects, which will be picked after the project submission. So stay tuned. And yeah, thank you again for your time, Adrian. It's always fun.
Sweet. Thanks so much for having me. Great to be here. Thanks, everyone.
Thanks, everybody.
Okay.
Have a good day.
All right. Bye.
Bye.